Hello everyone, it's Wednesday, February 4, and today we will analyze the charts for the euro and the British pound to identify potential market trajectories. Yesterday, pressure on the European currency and the British pound eased as demand for the US dollar, which has seen gain in recent days, began to fizzle out. It's clear that the market is preparing for a slight correction. It will soon be apparent whether sellers remain dominant or if buyers will push prices higher, especially in light of the ongoing challenges facing the US economy, including the action of Donald Trump and his administration. Although Tuesday's calendar included labor market data, it was not released. Meanwhile, it was reported that Trump signed a funding bill to end a partial government shutdown that began on Saturday. However, the market showed little reaction to this news, with the dollar remaining overlooked by buyers. Instead, market participants focused on remarks from Fed officials Thomas Barkin, who stated that last year's interest rate cuts provided support for the US labor market and emphasized that now is the time to refocus on inflation. This suggests that an increasing number of policymakers are advocating for a pause in rate changes in the near term. In contrast, Federal Reserve Governor Stephen Mirren recently noted that the Fed must lower rates by at least 1% this year. However, this is not surprising, as he tends to make such statements regularly. Turning to today's macroeconomic calendar, we have a series of reports on activity in the services sector. The Eurozone Services PMI is expected to remain comfortably above the 50-point threshold at 51.9, with the composite index projected to come in at 51.5. The UK Services PMI is estimated at 54.3 for January, indicating robust activity and could support the economic growth that Britain currently needs. The UK Composite PMI is forecasted at 53.9, which is another positive sign. Additionally, the market will focus on consumer price growth data in the euro area. Economists forecast the Eurozone's January inflation rate at 1.8%, with core inflation at 2.2%. Given that the European Central Bank's target is 2%. There are already discussions that such a significant increase in the euro could have a deflationary effect, potentially easing inflation further. Traders will also pay attention to data on producer prices in the euro area, which are projected to have declined by 0.3% in December. As for US statistics, the calendar features the EADP Employment Change Report, with private sector employment in the US expected to show an increase of 48,000. Furthermore, the US Services PMI is forecasted to register at 53.5, down from 54.4. Weaker than expected figures could put downward pressure on the dollar, stimulating a bullish run for both the euro and the British pound. Now, let's move on to technical analysis. The 1-hour EUR USD chart shows that a false breakout at 1.1827 would trigger a buy signal, with the euro climbing to 1868. A break in consolidation above this level would target 1908 and could open the path to 1948. At this mark, I would recommend going short on the rebound, targeting an intraday correction of 30-35 pips. Short entries at 1868 and 1908 could be considered only after a false breakout. Long positions could be opened at a false breakout at 1782 or on a rebound at 1741 in case of weak data from the euro area, aiming for a 30-35 pip move. Speaking of the British pound, a false breakout at 37.37 amid downbeat UK data could generate a sell signal. Going long would be relevant at 1.3677. If statistics disappoint, buyers could step in this area. Moreover, the level of 36.77 marks the midpoint of the sideways range, in which sterling could get trapped in the near term. A false breakout at 36.27 would likewise offer a buying opportunity. Long entries on a rebound could be considered at 35.93 in anticipation of 30-35 pip move. Going short would be prudent on a false breakout at 37.84 or on the rebound at 1.3843, near the 1-month high, expecting a move of 35-40 pips. Best of luck to everyone.